If you want to grow your money over time, investing is one of the best ways to do it. But with so many options available, how do you choose the right one for your goals and risk tolerance? In this article, we will explain the basics of index funds, ETFs, and mutual funds and how you can invest in them. What are index funds, ETFs, and mutual funds? Index funds, ETFs, and mutual funds are all types of investment funds. An investment fund is a collection of stocks, bonds, or other securities that are pooled together and managed by a professional fund manager. By investing in a fund, you can diversify your portfolio and gain exposure to a wide range of companies, industries, or markets. However, not all investment funds are the same. Here are the main differences between index funds, ETFs, and mutual funds. Index funds are funds that track the performance of a specific market index, such as the S&P 500, the NASDAQ 100, or the Dow Jones Industrial Average. Index funds aim to match the returns of the index they follow, minus a small fee. Index funds are usually passively managed, meaning that the fund manager does not actively buy and sell securities, but simply follows the composition of the index. ETFs, exchange-traded funds, are funds that trade on a stock exchange, like individual stocks. ETFs can track an index, a sector, a commodity, or a theme. ETFs are also usually passively managed, but they have some advantages over index funds, such as lower fees, higher liquidity, and more flexibility. ETFs can also be bought and sold throughout the day, unlike index funds, which are priced only at the end of the day. Mutual funds are funds that are sold by a fund company rather than on a stock exchange. Mutual funds can be actively or passively managed, depending on the fund's strategy and objective. Mutual funds can invest in a variety of securities such as stocks, bonds, real estate, or gold. Mutual funds have some disadvantages compared to index funds and ETFs, such as higher fees, lower liquidity, and less transparency. Why invest in index funds, ETFs, and mutual funds? Investing in index funds, ETFs, and mutual funds can offer several benefits, such as diversification. By investing in a fund, you can own a slice of hundreds or thousands of different securities, which can reduce your risk and volatility. Diversification can also help you capture the overall market returns, rather than relying on the performance of a few individual stocks. Low cost. Index funds and ETFs have very low fees, typically less than 0.1% per year. This means that more of your money goes towards your returns, rather than paying the fund manager. Mutual funds have higher fees, usually between 0.5% and 2% per year, but they may offer higher returns if the fund manager can beat the market. Simplicity. Investing in a fund can save you time and hassle, as you don't have to research and select individual securities or monitor and rebalance your portfolio. You can also automate your investments by setting up a regular contribution plan or use a robo-advisor service that can create and manage a portfolio of funds for you. How to invest in index funds, ETFs, and mutual funds. To invest in index funds, ETFs, and mutual funds, you need to follow these steps. Set your goals and risk tolerance. Before you invest, you need to define your investment objectives, time horizon, and risk appetite. This will help you choose the right type and mix of funds for your portfolio. For example, if you are saving for retirement in 30 years, you may want to invest in a combination of index funds and ETFs that cover the global stock and bond markets with a higher allocation to stocks for higher growth potential. If you are saving for a short-term goal, such as a vacation or a car, you may want to invest in a conservative mutual fund that invests in low-risk securities, such as government bonds or money market instruments. Choose a platform. To invest in index funds, ETFs, and mutual funds, you need to open an account with a platform that offers these products. There are different types of platforms, such as online brokers, robo-advisors, or fund companies. Each platform has its own features, fees, and selection of funds. You should compare different platforms and choose the one that suits your needs and preferences. For example, if you want to invest in index funds and ETFs, you may want to use an online broker that offers low commissions, a wide range of funds, and a user-friendly interface. If you want to invest in mutual funds, you may want to use a fund company that offers low or no sales charges, a variety of funds, and a dedicated customer service. Select your funds. Once you have opened an account with a platform, you can start browsing and selecting the funds that you want to invest in. You should consider several factors when choosing a fund, such as performance. You should look at the fund's historical returns and compare them with its benchmark and peers. You should also look at the fund's risk-adjusted returns, which measure how much return the fund generated per unit of risk. A higher risk-adjusted return means that the fund delivered more return for the same level of risk or less risk for the same level of return. Fees. You should look at the fund's expense ratio, which is the annual fee that the fund charges for managing your money. A lower expense ratio means that you keep more of your returns. You should also look at the fund's sales charge, which is the fee that the fund or the platform charges for buying or selling the fund. A lower or no sales charge means that you pay less for entering or exiting the fund. Fit. You should look at the fund's objective, strategy, and holdings and see if they match your goals and risk tolerance. You should also look at the fund's diversification and see if it complements or overlaps with your existing portfolio. You should aim to create a balanced and diversified portfolio that reflects your desired level of risk and return. Buy and sell your funds. Once you have selected your funds, you can buy and sell them through your platform. The process and timing of buying and selling funds may vary depending on the type of fund and platform. For example, to buy an index fund or a mutual fund, you need to place an order with the amount of money that you want to invest, and the fund will be purchased at the end of the day at the fund's net asset value, NAV. To buy an ETF, you need to place an order with the number of shares that you want to buy, and the ETF will be purchased at the market price at the time of the order. To sell a fund, you need to follow the same steps in reverse. Conclusion. Investing in index funds, ETFs, and mutual funds can be a smart and simple way to grow your money over time. By investing in a fund, you can diversify your portfolio, lower your costs, and simplify your investment process. However, you need to set your goals and risk tolerance. Choose a platform, select your funds, and buy and sell your funds carefully. By following these steps, you can create a portfolio of funds that suits your needs and preferences and achieve your financial goals.